I am proud to highlight Karnataka's crucial role in driving innovation in the aerospace and defense sector. Karnataka contributes to 65% of India's aerospace-related exports and caters to 70% supplier base for India's aerospace and defense industry. Supported by robust infrastructure, skilled talent, and global partnerships, Karnataka is shaping the future of India's aerospace aspirations. Invest Karnataka 2025 will further solidify our state's position as a preferred investor destination for aerospace and defense companies.
Ladies and gentlemen, welcome to Business Today Television. You are joined on Market Guru by a very well-known fund manager, Mr. George Thomas, who manages the equity portfolio at Quantum Asset Management Company. A very good afternoon to you, George, and a very warm welcome on Market Today and on Market Guru. Let's begin with your view on the market. We are seeing a fairly decent sell-off as far as broader equities are concerned. Today the primary issue is the very sharp fall that we've seen on the rupee, down for an 8th day in a row to a record low versus the dollar, plus the fact that you have these fresh issues coming in from the US geography as far as tariffs are concerned. What is your view on the broader market sentiment, and how do you see markets at this point of time?
The show. See, when you look at some of the primary drivers which led to the recent fall, one is obviously the sharp correction in rupee, which historically we have seen it happens in bouts, and our sense is we have seen most of it in the last few days, and obviously how the geopolitics moves around it and how the tariff moves around it, it has to be seen. But the larger point to note here is historically what we have seen is that even foreign investors who have been the large sellers in the recent times, they would realize that it happens in a large fall happens in a short period of time, and then at points in time. So considering that the larger fall is behind us, they could turn buyers at some point in time. But the current setup is, if you look at the global markets, the global bond yields are fairly strong. And if you add the depreciation factor to that, so Indian equities from a foreign investor may not sound very attractive at this point in time, given that the upside could be limited at low double digits at this time, considering that we have had a stellar rally in the last few years. But having said that, if you look at the larger cap universe, since they have gone through quite a bit of selling, so there are pockets of opportunities, or even from a universe perspective, our sense is, the return potential at this point is closer to what you would potentially have seen on the long periods of historic track record. So from that perspective, there is a valuation support which is emerging in that segment, plus a large part of depreciation is already behind us. So from that perspective, our sense is at some point in time, so even for foreign investors, Indian markets should turn constructive at some point in time during the year.
Okay, George, what would you think would be a sensible value for the rupee from now on? Of course, it's down 50 paise to a record low at about 88 now. Where do you think the tide will reverse for the better?
See, I'm not a macro expert, but our internal macro team's view is, so the rupee estimate which they have is very closer to where it is currently trading. But of course, it is bound to a lot of external variables, but to the factor that as long as crude is contained and, our exports are not very significant to the, and even some of our IT exports and things have caught up over the years. So to that extent, their estimate is, the bottom should not be very far from where we are currently.
Okay. Now let's come to where you are shopping and where you are sort of booking profit. As far as the overall AMC is concerned, since you are more towards the value investment side, what would be the level of cash as a percentage of total AUM across the board in the equity side?
See, some of the large schemes where we manage, the cash level is around 15%, which is slightly elevated from a historic perspective. But the interesting part is, unlike other markets where we had 15% cash, there were new, fresh opportunities where we were able to deploy even recently. So the recent addition was to a health insurance company which went through some short-term issues due to higher loss ratios and things. And when we look at their longer-term trajectory, we feel there is reasonable value in that name. So unlike other markets where we had a 15% cash, there are few stocks which are closer to buy levels. Obviously, most of them are in the financial domain, banking plus some of the insurance names.
Okay. Fair point. You've said BFC is a happy hunting ground. Where do you find value? Is it in public sector insurers, private sector insurers? We've just seen the government allowing 100% FDI as far as insurance is concerned. Do banking make sense? What's your call versus public and private banks?
See, if you look at, so our obvious preference goes for private sector banks. So for a fairly simple reason. So last few years, the credit environment has been quite benign from an NPA cycle. So in a good cycle, it is very difficult to differentiate between a good underwriter and a bad underwriter. And as and when that credit environment or that NPA cycle kind of normalizes, our sense is some of the leading private sector banks where the underwriting is far more superior should stand out in terms of valuations getting back to their long-term averages. So whereas public sector banks had a decent rally in the last few years, and from here on, from where their valuations stand currently, our sense is that the upside could be a lot limited compared to the private sector players. So coming to the insurance bit, so there are two names where there is reasonably good upside. One is a life insurance player where players are seeing some bit of margin pressures because of the commissions going up a bit. And the other is a health insurance player where we are seeing some bit of increase in their loss ratios where the underwriting losses have been slightly elevated for a cyclical reason. And they have been taking corrections in terms of price correction and better negotiation with hospitals and stuff like that. So our sense is from a longer term perspective, these are some of the pockets where there is opportunity. Again, coming to that budget perspective, some of the players who may not have a very clear promoter or owned by private equity, there could be a decent amount of interest from foreign players, considering that India is a market where there is a decent amount of long-term growth and out-of-pocket expenses still continues to be fairly high. So from that perspective, there is good long-term runway in terms of insurance penetration, and our sense is some of these recent issues are transient in nature. They do not seem to be structural.
Fair point. In terms of mid caps and small caps, as you would know, there is a massive controversy in the market at this point of time with the top fund managers saying that possibly SIPs in the mids and smalls should have stopped long ago. Which side of the argument are you on? And what is your opinion on valuations at mid caps and small caps? Are you touching or buying some shares there?
See, when you look at the problem, the mid and small cap, for a matter of fact, they remain expensive. But even there, if you look at our offering, so when I checked the data about a week back, when that median small cap stock corrected by about 30% from their index peak, so our fund it corrected by about 10%. So the message is very clear. If you're valuation sensitive, the fall could be a lot more contained. And even as a fund house, our belief is, so when you construct your portfolio, the core portfolio or your base of the pyramid, it should be contained with large capish names or large capish funds, which would be a lot more stable, and your allocation to small cap or mid cap as a segment should be a lot lower to what you allocate to large cap. So the problem is what most of the times, when you see a bull cycle, so investors tend to prefer segments which had fairly large trailing returns, which may not be the right way to construct a portfolio. So we have always stuck to this principle that when you have a pyramid, the bulk of the allocation, let's say 70% or 80%, should be towards large cap funds. And as you go down the ladder in terms of risk profile, your allocation should be lower. There could be periods where you see very high returns, but those are not sustainable from a longer term perspective. And even from within that small cap segment, you should allocate more towards funds which are valuation sensitive. So if you go behind quality and ignore valuations, it is bound to hit you hard at some point in time.
Okay. Sir, when you look at the broader markets and the fact that we've just gone through the budget, the consumption theme is coming up front, and perhaps the FMCG and the auto segments after massive correction are showing signs of fresh life. Would you agree to this argument, or do you still feel two-wheeler stocks, four-wheeler stocks, FMCG companies remain overvalued?
See, we have few two-wheeler names in the portfolio, but from a cohort perspective, those have not turned cheap. So we have been sellers in some of those names, but of course, we added a bit to a rural-focused two-wheeler name. So if you look at that budget announcement, the estimate is there could be a consumption boost of about 1 trillion. But the fact is, if you were to look at the last 5 years, from the point of inception of the new tax regime till next year, when we would see some of those benefits kicking in. So if you adjust for inflation, the change in tax slab is not a very material change. One, if you adjust for inflation plus you remove some of those deductions which were existing in the old tax regime, the change is not very material to kickstart a very massive consumption boom. That is point number one. The point number two is, so if you look at the household savings, that has taken a hit in the last few years. So some part of these savings in tax outgo could be routed towards rebuilding your savings part of household savings as well. So if you add up all of these, it may not be a very massive consumption boost, but of course, from an incremental year-on-year perspective, things could become better. Staples continues to be expensive from a valuation perspective, especially from a value standpoint, and we don't see a level where at least from a value perspective, we don't see staples have reached a level where you could expect reasonable upside from the levels where they are trading right now. There could be marginal benefits on when you look at year-on-year perspective, but our sense is, even when you look at government's own expectation in terms of growth in those income tax, our sense is the actual benefit could be a lot lower than the general expectation.
Fair point. George, I was looking through your portfolio, and for both the ELSS scheme and the long-term equity fund, you've chosen to hug the Nifty in the sense that a large percentage of the equity that are represented in the fund are the form of Nifty companies. Is this a deliberate strategy for sort of avoiding the volatility in the mid caps and small caps?
See, what we historically have is a liquidity filter, where we invest in, as a first screening criteria, we invest in stocks which has an average daily turnover of at least $1 million. So when you have that liquidity criteria, and the reason why we have is when volatility hits, some of those mid and small cap stocks which looks very attractive in a bull market might see reasonably strong drain in terms of liquidity, and therefore the actual traded value might be nowhere close to what you could realize. And because of this liquidity filter, a portfolio tends to have a large cap bias. So when we construct portfolio, we do not look at what the Nifty weights is, and even if you look at our active share, it would be fairly large because our weights are very different from what the Nifty holds, and even in terms of the framework which we use, the weights are decided in an entirely different fashion. But the inherent bias towards the large cap names is because of this liquidity filter. And the reason why we have a very high banking share is primarily because the valuation comfort is more in some of those banking names. And therefore, that is reflected in a higher weight in those banking names. It has nothing to do with how things have panned out recently, but one, it is a valuation filter, and number two, it's a valuation comfort call, where banks have a relatively better, valuation comfort at this point in time.
Is it, George, because you do a lot of mid and small cap funds also, how would you advise unit holders in your AMC to navigate this massive volatility that we are seeing on the small cap and the mid cap space? Of course, I don't expect you to tell them to stop their SIPs, but what is your own personal view on continuation of SIPs, as also how to navigate the next maybe 2 years in mids and smalls?
See, so not just for this year, but our advice always has been to have a larger allocation to the large cap strategies. Like for instance, the value fund which I manage, Quantum Long-Term Equity Value Fund, generally tends to be more large cap tilted. And the reason is very simple. So if you look cross cycle earnings growth or even the volatility, the risk remain relatively on a lower side, whereas if you go down the ladder to small cap names, the revenue concentration can be a lot higher, and the earnings are more prone to economic cycles. So for this precise reason, we have always advised investors to have a larger allocation to large cap tilted funds, like the value fund or funds which are funds which are more large cap tilted, and to have a smaller allocation towards small cap. Of course, by the sheer size and some of the positioning there, the long-term growth prospect could be slightly higher, but it comes with its own share of risk. So there's not been any material change in terms of our advice, but our advice is always been to have a larger allocation to large cap strategies, and as you go down the ladder, to reduce the share there.
Okay. And George, how are you navigating those earlier favorites, the defense space, the thematic sectors in terms of PSUs and railway? Are they now off the charts forever?
See, so we are not against any of these sectors, but inherently we are more sensitive to valuations. And when you become valuations, when you match the stock prices with the themes or the euphoria which goes around, or very often many of these themes gets filtered out of our universe. So our sense is many of these names have factored very strong earnings growth, which may not be realistic, because over longer periods of time, if you look at it, so the defense spends tend to grow in line with the nominal GDP growth. Even if the order books could grow multi-fold in a short span of time, the execution timelines tend to be fairly stretched. So from that perspective, many of these names did not turn attractive in the first place, and therefore we being valuation sensitive, we stay away from many of those names, primarily because we don't expect the market prices versus the earnings compounding, which is realistic, to kind of tie in many of those names.
Okay, fair point. And what about the international allocation to, how should I say, a new investor that is coming in? US seems to be headed into some sort of a inflationary spiral, with Mr. Trump continuously threatening or actually putting in tariffs to sort of make life difficult for countries like India and China. how much international exposure would you advise a new entrant into the market as a part of the overall mutual fund portfolio?
See, so our advice always has been, or our endeavor has always been to invest into things which you understand, and therefore, as a fund house, we do not have any offering in terms of international offerings, primarily because our sense is, since you're not operating in that economy, it might be difficult to understand those companies from a bottom-up perspective. But there are, of course, portfolios exposure in terms of IT or pharma, where there is a fair bit of exports. And if you were to look at the way things are progressing there, and if at all he's able to give some bit of corporate tax cuts or things, our sense is, some of those IT spendings could see a push in terms of better disposable income. Things would, and there are certain pharma themes like API manufacturing or domestic manufacturing, which could benefit if we were to assume a manufacturing shift away from China. But we don't expect any of those manufacturing shift to happen overnight, because those supply chains have taken years to build, and there is a reasonable amount of ecosystem which is in place. But incrementally, our sense is over long periods of time, if this strategy were to prolong, it is beneficial for from an India standpoint.
Okay, George, we also have this record high that is coming in on gold at a time when paper gold ETFs and sovereign gold bonds have been sort of not really in the fancy for the right reasons. What would be your call on gold? Do you see it hitting $3,000 an ounce soon, or is it overheated and over the top?
See, I don't have a target for gold, but the way we look at gold as a fund house is one, during market turmoil or during economic turmoil, for let's say it be the pandemic or a financial crisis or a war. So those are times when gold comes to rescue. So we don't advise gold from a return generating perspective, but from a portfolio perspective, if you have a mix of equity and gold, there could be times when equity markets would take a hit for economic reasons or geopolitical reasons. And those periods of time, if you have an allocation towards gold, we have seen the portfolio tends to be more resilient. And even from an asset allocation perspective, you could have an opportunity in terms of rebalancing and moving money out of gold and deploying in equities. But this, if you look at the last 5 years, it has been a fairly, so if you look at it, even the gold has rallied, equity has rallied, so everything has rallied in tandem. So that is not a scenario we believe could be if you look at the longer term history. So you can have gold as a strategic diversification tool to help you when the economy is not doing good or there are geopolitical risks. But we don't advise that or we don't think of it as a return generating tool.
Right. And my final question to you, George, your view on bonds and interest rates. We are in the second month of February. Where do you see Indian interest rates 3 quarters from now, maybe same time next year? And what would your advice be on bond funds, long-term bond funds as a part of your portfolio? Would you allocate some percentage to them?
See, a lot of times what we have seen is Indian investors, they don't understand that bonds as a product. So many of them, they don't realize that bonds are an asset class which can have negative returns. So for that reason, we don't generally, for a naive investor or for a layman investor, we don't generally recommend bond funds to that extent. But we have an offering which primarily invest in GSECs and PSU names, where we do not take any sort of credit risk, or it's kind of risk-free to that extent. But the interest rate trajectory, it's quite dynamic at this point, and our general sense is it should go downward. But The point is, it is also dependent on how the global interest rates move, or how, let's say, some of those global policies kind of turn out, and how those inflation trajectory kind of pans out. So it's a fairly dynamic situation at this point in time. But as a portfolio construct perspective, our general advice has been to have an emergency corpus, and to have a mix of equity and gold, for the simple reason that those are kind of complementary in nature when you have looked at long periods of economic cycles in the past, and that should hold true even for the long term.
Right. Thank you so much, George. It's a pleasure listening to your views, and let's hope for the very best that equity investors can get out of 2025. From the face of it, it looks to be a troublesome year. Thank you for your time. I hope you enjoyed this conversation as much as we did. This, ladies and gentlemen, was Mr. George Thomas. He's the fund manager at Quantum AMC, and manages Quantum Long-Term Equity as well as Quantum ELSS Fund. Do keep tuned on to Business Today Television. There's a lot that's happening on the other side of the break. Thank you for watching.
Karnataka is the fourth largest automobile producing state in India, contributing 8.5% to the nation's vehicle production. The state also has the highest number of EV charging stations, boasting an impressive 5,765 public stations. We were the first to introduce an EV policy in 2017 and will soon unveil a clean mobility policy at our upcoming Global Investors Meet. Backed by our progressive policies, world-class infrastructure and a skilled workforce, Karnataka is paving the way for growth in both traditional and EV sectors. Join us at Invest Karnataka 2025 and be a driving force in the future of automotive and EV innovation.
It's a great sunny day and we are in Royal Ranthambore Business Today Golf in the Kolkata edition, and I've joined by the bunch of gentlemen over here. Let us first introduce them. Sir, first your introduction.